PayPal, one of the leading companies in the payment processing industry, has reported mediocre results in 2022. The company's revenue has increased by 5.8%, but its net income has decreased by 42% year over year. As a result, the stock price has plummeted by over 67% since then, and on their Q2 earnings posted this week, the stock dropped by almost 12.5%. Today we'll take a three-step approach to thoroughly evaluate the company and determine its fair value. In step 1, we'll be looking at PayPal's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here, we'll delve into PayPal's financial statements and assess critical metrics and ratios. In step 3, we will be using a combination of valuation models such as discounted cash flow and Graham's valuation to gain an insight into the value of PayPal's business. By using these methods, we can determine whether the stock is currently overvalued or undervalued in the current market based on different metrics. In conclusion, by combining the findings from the three steps, we'll ultimately determine the fair value of PayPal as an investment opportunity. To determine the final valuation of the stock, we'll be using a margin of safety. This margin of safety will be based on financial health, financial growth, and the ratios of the company, and we'll be using a standard margin of safety of 20% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to take a look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green mean a 5% deduction, and bright green mean a 10% deduction from margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from margin of safety. The first two metrics that we'll be using are the margin and EBIT growth. The EBIT has gone up over the years, going from just under $1.1 billion in 2013 to over $4 billion in 2022. The average EBIT growth during this period is 16%, which is in the light green part of our scale, indicating a 5% deduction from margin of safety. The margin has gone down over the years, going from 16.2% in 2013 to under 15% in 2022. The average margin decline during this period has been sitting at 0.6%, which means no change in the margin of safety on this metric. The final two metrics that we'll be using are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for PayPal, as you can see in the top chart, their cash position is currently greater than their debt, meaning that they have no net debt, indicating a 0% debt to EBITDA ratio, which is a 5% deduction from margin of safety. The return on invested capital for PayPal is sitting at a very solid 13.5%, indicating that the management is very effective at allocating capital, which awards them with yet another 5% deduction in the margin of safety. Looking pretty good so far for PayPal. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of PayPal going from 2016 to 2022. The average growth rate in their free cash flow annually during this period has been sitting at almost 30%, and I'm projecting their future free cash flow to grow by 4% annually for the next 10 years, and with this percentage we'll determine the future free cash flow for PayPal and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This leaves us with a sum of free cash flow of $97.9 billion, and to get an equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of $98.1 billion, and dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $87.63, which is a 37.6% upside from the current price. The second model that we'll be using is Graham's revised valuation formula. In this model we take a look at the earnings per share that PayPal is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory of Benjamin Graham that a PE of a company with no growth should never exceed 7. And looking at all of these metrics, we get a fair value out of this model of $55.35, which is just over a 13% downside out of this model. The next model that we'll be using is the multiple valuation. In this model we take a look at similar companies to PayPal, look at their stock price and their earnings per share. This way we can determine the average PE multiple in the industry, which in this case is sitting at 35.7. All left to do then to get a fair value is to multiply by the earnings per share, which for PayPal is sitting at $2.32 a share, and doing this we get a fair value of $82.82, which is just over a 30% upside out of this model. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metric that we use to determine this is the PE ratio. In this case, I've imported the PE ratio of the past 5 years, and on average it has been sitting at 52.1, while the current PE ratio is sitting at 27.45, indicating that's currently significantly undervalued on this metric, giving us a fair value of $120.86, which is almost a 90% upside from the current price. Let's go look at the final overview of a valuation next. Looking at our final overview, we've imported the discounted cash flow, grains valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $86.67. Margin of safety we've determined earlier using a standard margin of safety of 20%, deducting it by 5% for the debt to EBITDA, EBIT growth, and the return on invested capital, leaving us with a 5% margin of safety. Applying this margin of safety, we get a fair value of $82.33, and with the current price of $63.66, we get an upside of just over 29%, indicating that's a buy through our valuation. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and if you want to get access to all of the models that I use in my videos and much more, you can check in the description for my Patreon link. Thanks for watching.